Welcome to Session 1 on Nonprofit Financial Management. This video will introduce you to nonprofit structures, accounting principles, and budgeting strategies. The goal of this course is to help you understand resource allocation so that scarce resources are used efficiently. You will also learn financial analysis and improve your decision-making using financial information. Legally, nonprofit organizations are distinct from for-profit entities. Nonprofits are mission-driven and cannot distribute surplus revenue to owners or shareholders. Any surplus must remain within the organization to advance its mission. Most public charities are 501c3 organizations, which have tax-exempt status and can receive tax-deductible contributions. However, they face restrictions on political activity and must use income solely for the nonprofit mission. Financial management is management based on an understanding of an organization's finances. The key concept is that resources must be closely linked to the organization's mission, especially since governments and nonprofits serve public purposes. There are two main types of accounting. Managerial accounting generates information for internal decision-making and is forward-looking. Financial accounting provides retrospective information to stakeholders and focuses on historical data. A budget is a plan for getting and spending money to reach specific goals. The budget cycle includes 4 steps: plan, implement, control, and measure results. Budgeting is a planning tool that helps assess the feasibility of short and long-term plans. It drives strategic thinking by forcing organizations to look years ahead. Budgeting also serves as a communication tool. Internally, it clarifies goals for staff, and externally, it demonstrates credibility to donors and other stakeholders. Finally, budgeting is a management tool. It requires realism and consistency, allowing for regular review to spot early warning signs and enabling contingency planning. Organizations utilize different types of budgets. The operating budget covers day-to-day activities, the cash budget monitors cash flow liquidity, and the capital budget deals with long-term assets. Other types include master, performance, flexible, and zero-based budgets. To create a budget, determine operational requirements, project fixed and variable expenses, and project revenue sources. Crucially, add contingency for uncertainty and develop alternatives while testing assumptions. Let's use a case study: the Mason trip to South Korea. The goal is to send students for 2 weeks with a $10,000 alumni contribution. Can this trip be run successfully and responsibly? Budgeting starts with market analysis and pricing. We compare competitor rates and propose a pricing structure, acknowledging the added value of our trip. Budgeting is an iterative process. Initial assumptions about student count, price, and costs are revised to ensure feasibility and impact key line items, such as increased revenue or reduced cost. There is no magic to budgeting. It requires thought, estimating likely receipts and payments, and making reasonable assumptions to sustain the mission.